This is Wednesday, November 19th. My name is Kris Patel. I'm Managing Director at Simplify ETFs. I am joined today by Jason England, the resident Fed whisperer, I guess you could say, at Simplify, as well as portfolio manager of a few of our fixed income strategies. Jason, thanks for hanging out with us today. I know we don't have a Fed meeting today, so why don't we just kind of jump into the Fed meeting minutes that were released? Maybe give us a little overview of what was talked about in those Fed minutes today.
Yeah, thanks, Chris. Yeah. No Fed meeting this month. It's kind of that in between the October and December, and we haven't really had much data either because of the well, we haven't really had any of the government data because of the government shutdown. Obviously, it's reopened, so really trying to dig into the Fed minutes and see it as, what can we glean from that, going into the next meeting and see kind of where the tone of the board is right now. And I took these as somewhat hawkish, and that kind of aligns with Chair Powell's cautious tone that he had in his press conference post the last meeting, where he kind of
Yep.
pushed back and, kind of really said, that they're going to be meeting by meeting and they're on no preset course. And, so there's not this foregone conclusion that the next meeting that they're going to do a cut. And then when you start reading in the minutes, you started to see that they use these words many and several. So many of the participants thought it was likely that it would be appropriate not to do another cut this year, and only several thought that they would do or that there would be a need or appropriate to do another cut this year. So you see that kind of division right there, but many is taken as more than several in Fed speak. And then the other thing is there was there was a handful that really didn't want to ease at the last meeting, so you could see
Okay.
that tension over that. And we did get two dissents, as you remember. Um, you know, um, Regional Fed President Jeff Smith dissented. He wanted to stay hold, and then Fed Governor Stephen Myron obviously wanted to do 50, so he wanted to do more than the 25. So you're starting to see that build up, and then really these minutes are really showing the uncertainty around the likelihood of a December cut and what they're going to do and the kind of the division among the committee. So you can start to see, that the hawkish tone was a little bit, but you still have some dubs pulling at it in it. So the minutes, obviously these are backward looking. That meeting was a while ago now, but like I said, not a lot of data. So we're trying to glean where the Fed is at in it. Coming away a little slightly hawkish is what I would take from these minutes.
Very good. So yeah, we actually had that announcement today, right, on the BLS data. Maybe share what came out with that and some of the ramifications that hit the markets as far as what they announced today.
Yeah, so they came out and they're basically not going to have a October employment report. We're going to get the September delayed September report tomorrow morning, but we're not going to get an October, and they're going to try to take some of the payroll figures and put that into the November report. But the November report now is going to be released after the next Fed meeting. So on
Oh,
December 16th, the Fed meeting's on the 10th. So this really clouds the picture now for the Fed even more. So you don't have the employment side, and that's really kind of the trigger right now, I think, that is pushing, some of the, maybe making some of the those that are leaning or split, whether they're leaning on a hold or a cut. They don't have the data, they might lean and stay with the hold. Obviously, the doves are already at this point now where they think there's enough data in the labor side, especially on the private side that we've been getting recently. Not the government obviously hasn't been released, but the private side, that it's weakening enough that they want to do another cut.
yeah, so there is some tension, right, on the board as far as a cut, no cut, and they're kind of flying blind, right, as far as like with the data and with the government shutdown and stuff like that. I've got some slides here we can kind of would love for you to kind of go over, Jason, as we continue to kind of talk about the ramifications of the meeting minutes as well as what potentially will happen going into into the future. Maybe touch on this real
Yeah.
quick, and then we can jump to the next one.
Yeah, so here right now is this is live this morning. Going into the last meeting, we actually saw close to 100% chance of a cut at the December meeting. They
Yep.
fully priced in the cut in October. There was almost 100% priced in as well for a cut at the December meeting. This dropped below 50% recently, but then this morning on the release of the news around the BLS, canceling the October employment report, it sunk even further. Now we're down, got as low as below 30% probability. Now it's a little bit above. So you're starting to see now, and there is that division I was just talking about among the Fed. So you're starting to see now, like maybe those, you've got, it's almost evenly split. You have nine members who don't want to cut. This is the FOMC board or a committee. You have nine, so not all the voters, but you have nine that just analyzing their dot plots and their Fed speak. Nine of them that really don't want to do another cut at this meeting. You have another nine who do, and then you have the one outlier in Stephen Myron who wants four more cuts this year, and we only have the one meeting left. So, and really what it is it's hinging on the fact that you have those that are arguing inflation is still elevated, well above their 2% target, and those are the
Yep.
ones that are on that hold and more worried about elevated inflation persisting. And then you have the other side, the dovish side, that are feeling like they're not as worried about inflation as much. It has come down obviously quite a bit, from the peaks back in, 2021 and 22 when we peaked out in inflation. So that has come down. So they are still worried about it being somewhat elevated, but they're not as worried as much as they are. They think there's more downside risk to the labor market. So that's what's really weighing between the two right now. And, after today's, BLS announcement and the probability now, the market's starting to price in, and this will give Chair Powell an opportunity to form a consensus, maybe now on hold, because the market, they're not going to upset markets if they stay on hold because it's already starting to price out a cut in December.
Yeah, it really kind of speaks to, the dual mandate at the Fed, right? Inflation and employment. That's kind of at odds at this point in time. So I can see how this division is kind of bubbling up with at the Federal Reserve. What are we looking at here, Jason?
Yeah, so this is really just the Treasury curve since the last meeting. And as
Yep.
I said, there was as we saw in the minutes, a little bit of a hawkish tone, but obviously we didn't see that. But we did see in the press conference, and then since then, a lot of Fed speakers pushing back on the idea that we need a cut in December. And that's really elevated, not much, but you see a little bit, mostly across the back end of the curve. You've seen rates somewhat moved higher. Usually you get a 25 basis point cut that usually brings rates down a little bit and lower, but we've seen a little bit of a push back up in rates and they've kind of stayed kind of range bound since then. Obviously, like I said, not a lot of data, just private data until the government has now reopened, but we're slowly going to get that on delayed releases. But when you think about it, is there's the rate market's been somewhat in a range because you haven't seen the data that's going to shock it one way or the other, thinking, okay, they are going to cut, they're not going to cut. So that's really led to a little bit of a backup in rates, more just around the hawkish Fed speak we've seen, starting with Powell at the press conference. So, we've seen a little bit of uncertainty with that because of lack of data, and now you've seen a little bit of bond volatility as well recently.
Yeah, so this speaks to something we also hear with clients, Jason. It's like, the expectation is the front end of the curve will come down, but everybody's kind of a little bit confused on what's going on with the middle to the back end of the curve. Any quick thoughts on that? Because you just showed obviously that, the back end actually kind of increased since the last rate cut. Any kind of clarity or thoughts? I know it's market based, but would love to hear kind of your thoughts on that.
Yeah, I think that's a lot of that's around, like I said, that hawkish rhetoric around those members that feel like inflation is still elevated and
Yeah.
they're worried that it could persist and stay elevated or maybe push higher. And that's what's pushing back in rates. Obviously, the Fed, we know, can only control the Fed funds rate. So that's the front end of the
Yep.
curve.
Yep.
That's usually what they can bring down. Back end rates are a lot of it around the fiscal side of the equation, as well as the inflationary pressures we've felt, obviously since the tariff tantrum back in April. And so that's kind of where you've seen, like this chart shows you here, is bond volatility has come down a lot because we've had a little bit more clarity on the tariffs. We've seen the Fed at least ease twice now. So you're not really seeing as much volatility in rates because you're still getting a little more certainty of their path forward. The hiccup here was when the government shut down and you
Yeah.
stopped getting data on October 1st. and then now reopening, you started to anticipate, not only the lack of data, but the government shutdown causing a weakness in the economy, which would lead to, yes, more cuts by the Fed, so affecting the front end, but the back end maybe staying elevated because the fiscal side is going to have some issues with the economy going forward. So that's really what's kind of been playing the dynamics. But as we see here in this chart, it was a pretty steady path down, but then in recent months, we've seen it tip up a little bit, really over the last couple of weeks more, is that that it's gone a little higher now because this uncertainty over the government reopening and what data we're going to get and what it's going to look like, as well as now the uncertainty what the Fed's going to do at the December meeting. Obviously, we're going to start getting holiday season here, so you start seeing less liquidity in markets. You start seeing we're getting close to the end of the year, so not a lot of time before that meeting. And obviously, some of this delayed data is gonna hurt their ability. It's gonna make it more cloudy for them to make a decision on that day.
Very good. Yeah, I love looking at the move index. For those of you that don't know, the creator of the move index is at Simplify, Harley Bassman. So we're very appreciative of that. So we see the volatility in the markets, especially in the fixed income markets, actually in the equity markets as well, kind of climbing up here. What do you think this all means as we go forward, Jason, as far as rates and kind of your look through on fixed income action as we head into the end of the year?
Yeah, I think even though we have this uncertainty and division on the Fed, and they have cut the rate by 150 basis points
Yeah.
from the peak. So you're starting to see, at least we've seen rates settle in a little bit lower ranges now. Take away the tariff tantrum back in early April when rates shot up because of the announcement of the tariffs, but since then, we've seen them somewhat stabilized. They're somewhat range bound, and they're coming down to some extent. So, really, I think it's now, fixed income should be top of mind in your portfolio. This is when active management in fixed income should be, prominent in your portfolio, and you should look to see how you can take advantage of, regardless of the tension among the Fed and whether they cut or don't cut in December, the direction of travel still appears to be going lower in rates.
Hmm.
Maybe not as fast, or it's going to be a little bit more gradual than maybe the Fed is suggest, or the market has been trying to price in. Maybe the Fed's going to be a little slower. So either way, the direction of travel is lower. So really, it's like I said, it's time for fixed income to be looked at in your portfolios. There's several layers of fixed income you can look at, whether it's a core bond fund where you want to take advantage of falling rates with some intermediate duration. Do you want to play the treasury option income part of when you see rates? Maybe they're volatile, but they're staying in a range. There's other areas where, agency MBS still look attractive. Their spreads have come down a little bit, but they're still historically much wider, thus higher yields in that space than maybe investment grade credit that is trading very tight right now. So there are opportunities in fixed income, and that's where you really want to look at an active manager and see where we can take advantage of these opportunities. And even though there is some uncertainty and cloudiness with the path forward, not just for the Fed, but rates, the direction of travel, like I said, seems and appears to be going lower. Just maybe going to be a little bit more gradual, and there could be some hiccups along the way. So that's opportunities to, enter into fixed income and some of these different asset classes within fixed income to take advantage.
Yeah, and high yield credit spreads are pretty tight. They've kind of come out a little bit here as well. So again, another area in the market on the fixed income side, you probably want to look at some options there as you try and navigate the interest rate environment, right? Well, that sounds great, Jason. Anything else you want to wrap up with as we head into the close here?
No, I think that's it. Obviously, we've got the one more meeting this year, and then we head into holiday season. So a lot to navigate. So, once again, look at your fixed income portfolio and look at active management, because this is the time when you really can take advantage of these rate moves, especially with the Fed somewhat in an easing cycle right now.
Yeah, well, great, Jason. Thanks for jumping on today. We love having you as a resource for us at Simplify as well as our clients. For those of you watching, please reach out to simplify.us or go to our website at simplify.us If you have direct questions for either myself or Jason, you can reach us at info@simplify.us. Just send us a quick email. We're monitoring that inbound. And then we look forward to seeing you on, I think it's December 10th. Is that right, Jason?
That is correct.
Yeah, December 10th, we will have another Rates on the Run to kind of dig into what everything Powell says and company is looking forward to again as we go into 2026. So with that, Jason, thanks again for your expertise, being a resource for both us and our clients. And until next time, December 10th. Thank you.